Last week, three separate headlines called the same stock a buy, a sell, and dead money. Same company, same data. Three completely different conclusions. That's not analysis, that's content production. In the next 7 minutes, I'm going to show you exactly how to filter out the noise and identify the signals that actually move the needle for your portfolio. Here's a data point that should concern every investor. In 2022, the S&P 500 fell roughly 20%. The number of financial news articles published that year rose by 34%. More noise, worse outcomes. No correlation between volume of coverage and quality of information. The problem isn't a lack of information, it's the inability to separate signal from noise. Amazon gets 400 news mentions on any given week, but only 3 or 4 of those actually matter to a long-term investor. So what does that actually mean for how you spend your time? It means most of what you read is shaping your emotions, not your analysis. Financial media has one job: keep you watching, not keep you profitable, not keep you rational, keep you watching. Uncertainty drives clicks. Stock could surge 40%. Outperforms company-reported stable earnings by 6x in average click-through rate, historically. Take Nvidia in 2023, the stock was covered in every possible frame. AI revolution, bubble territory, must own, overvalued, undervalued, sometimes on the same day. None of those headlines told you anything about Nvidia's actual free cash flow generation, its gross margin trajectory, or its competitive moat. The data did, the headlines didn't. Not all financial news is useless. There are 3 distinct categories. Type 1, signal. This is primary financial data. Earnings releases, 10K filings, Fed policy decisions, macroeconomic data like CPI or unemployment. This information directly affects company fundamentals or the discount rate. Read everything in this category. Type 2, context, analyst reports, sector commentary, and macroeconomic interpretation. Useful for framing, but only if they cite primary data. If an analyst says Apple's services margin is expanding, check the actual margin data. Use context to form questions, not conclusions. Type 3, noise, opinion pieces, price target revisions without updated thesis, social media commentary, and breaking news that hasn't been verified. This is the 90%. It feels productive to read. It isn't. Here's the filter question. Does this information change anything I would calculate about this company? If the answer is no, move on. When any financial news lands in front of you, run it through 3 questions. Question 1. Is this primary data or opinion? Primary data has a source, a filing, a report, an official release. Opinion has an author. Question 2. Does this change a fundamental number? Revenue, margin, free cash flow, debt load. If the news doesn't affect one of these, it's noise. Question 3. Would I have known this in a week anyway? Most breaking financial news is reported, re-reported, and clarified within days. If it's not actionable in the next quarter, urgency is manufactured. Apple's Q4 earnings miss. Signal. Analyze the numbers. An analyst saying Apple looks overvalued without a model? Noise. Move. Based on the numbers, these 5 sources consistently produce signal. SEC Edgar filings. The primary source. 10Ks, 10Qs, 8Ks, slow reading, high signal. Earnings call transcripts, not the headlines. The actual transcript. Management language reveals more than summaries do. Federal Reserve releases FOMC statements, meeting minutes, and the Beige Book for macro context, sector-specific data for industrials, PMI data, for tech, CapEx cycle data. Tailor your signal sources to your holdings. Short seller reports. Counter consensus, heavily researched, often cited, not always right, always worth reading. Notice what's not on that list. Reddit, Twitter, CNBC breaking news, YouTube finance influencers. That doesn't mean they're always wrong, it means they're not primary signal. Data points that support the narrative. Market-moving events, Fed rate decisions and earnings, surprises are widely covered and do drive short-term price action. Retail investor growth. Over 20 million new brokerage accounts opened in 2020-2021. News access increased alongside market participation. Information speed. Real-time news can price in events faster, reducing information asymmetry for retail investors versus professionals. Data points that contradict the narrative. Retail underperformance persists. Despite unprecedented news access, retail investors consistently underperform index funds over 10-year periods. Recency bias amplification. Heavy news consumption correlates with recency bias, causing investors to overweight recent events versus long-term base rates. Noise-to-signal ratio worsens. Financial content volume has grown 300% plus since 2010, while the number of fundamental data releases has remained static. Calm, evidence-based verdict financial news informs. It also misleads. The distinction depends entirely on your ability to filter. The data shows that access to more news does not produce better investment outcomes. Structured, primary data-focused analysis does. The 10% that matters is entirely findable. The 90% is designed to keep you engaged, not informed. The most common mistake isn't reading bad information. It's confusing consumption with research. Reading 15 articles about a stock feels like doing the work. It often isn't. Here's the distinction. Research produces an output, a number, a thesis, a quantified risk. Consumption produces a feeling, confidence, concern, conviction, without the model to back it up. When investors say, "I've been following this company for months," what they usually mean is they've been consuming headlines about it. That's not the same as reading the CE last 10Ks. It's not the same as modeling free cash flow. The filter isn't anti-news, it's pro-rigor. The discipline of investing is, in large part, the discipline of ignoring things. 90% of what gets published about markets is not designed to make you a better investor. It's designed to keep you on the page. The investors who consistently do well aren't better at consuming information. They're better at filtering it. Use primary data. Run it through a framework. Ignore the rest. If you want to see the signal score applied to a specific stock, where we score business quality, valuation, momentum, risk, and sentiment against real numbers, that video goes up Thursday. Subscribe so you don't miss it.